Gentlemen, great to have you with us. Barry, I want to start off with you. What do you make of this start to a rotation? Looks like a rotation, at least, when you have financials, energy, utilities leading the way at the expense of technology.
Well, to an extent, it does feel like too much money chasing too few ideas. It's very hard to make that rotation from growth to value, from disinflation to reflation without there being some interruptions in the market. So I think it's just a lot of money, a lot of liquidity, a lot of algorithms that are just saying, well, these didn't go up, let's buy them. The other ones, they went up a lot, let's sell them. So it's almost like a computer-driven rebalancing.
That doesn't sound, I mean, is that what you agree with in terms of the fundamentals? I mean, yeah, the computers are doing it, but what should you do?
Well, the first 1,000 points on the S&P 500 off the March lows we caught, but we missed the last 400 points here to the high 3,500s. This market feels very frothy to us at 24 times our estimate for 2021 earnings, which is 10% below the consensus. And we have some concerns going into the autumn in terms of virus news, vaccine news, political news, even economic news as far as the consumer service economy.
I mean, muscle memory for many investors is that the fall is usually a treacherous time for markets. Starting in September, October is typically a terrible month for investors. Greg, a lot of people are pointing to the rise that we've seen in the volatility index, the VIX, alongside the S&P 500 making new highs. Are you concerned about that at all? I mean, Liz Ann Sonders had this interesting chart this morning saying of 20 past occurrences where this has happened. 17 of those occurrences where the S&P 500 has hit an all-time high with high volatility index readings have happened in the late 90s.
Yeah, it's certainly an unusual configuration for markets. And we have to be a little bit cautious about trying to predict what it means for markets based on what we've seen previously, because we've only really seen this instance once, and it was in the late 90s. And I think there are some things in terms of positioning, particularly in tech and how narrow the rally has been, that really echoes the late 90s. So that's definitely a red flag for market. But there are a lot of things, such as the rate environment and what the Fed are doing, which is very supportive for equity markets, notably very different to the late 90s.
Hey, Barry, I'm trying to think back to some of your earlier calls in the summer. But it seems to me that, as I remember, part of your working thesis was to await the arrival of fresh either monetary or fiscal stimulus. Do I have that right? And is that intact? Has the logjam between the speaker and the leader in recent days done anything to change that?
Yeah, Carl, when you think about it, the first 1,000 points I referred to the low 3,000s on the S&P 500 index off the March lows, that was a combination of fiscal and monetary policy. There were good reasons for that. We played that rally. Junk and investment-grade spreads came in dramatically. But now we have some concerns. Okay, we know that price level targeting or allowing an inflation overshoot by the Fed is here. That's been coming, though, for 2.5 years since President Bullard of the St. Louis Fed did it in a PowerPoint, explained the whole price level targeting concept to a presentation. So I think a lot of the good news is embedded in the market. Now there's some angst about the autumn, and we would share those concerns as you go into the fall.